Greed is a state of mind when you actually don't know what is happening.
Let's break down a very popular topic, trader psychology. How do you usually explain the role of emotion in trading to some newer traders, let's say?
Emotions exist in trading because traders take risk and they operate in the uncertain environment.
Do you have any specific habits or systems that help you keep that fear in check?
Fear might be helpful when you navigate in the new markets, in the new strategies, in the unusual situation when you don't have any experience.
We have fear, but we also have greed. What do you tell someone who just can't stop chasing the next big win?
I would distinguish here greed from risk appetite. Risk appetite might not be the bad thing.
Hello and thanks for joining us on our weekly episode of Exness Trading Talks podcast. Last time we discussed stagflation, where it originated, how to spot it in modern markets, and how it compared fundamentally. This week we will talk about trader psychology, tips on managing fear and greed emotions, and how to find balance between the two. You can get notified about our new episodes if you subscribe to our channel and turn on notifications. My name is Antreas, Themistokleous, and together with us we have Stanislav Benukhov. Hello, Stan.
Hello, Antreas. Thank you for having me today.
Okay, so let's break down a very popular topic, trader psychology, right? Everything has to do with human psychology when it comes to trading. So how do you usually explain the role of emotion in trading to some newer traders, let's say?
So yeah, emotions exist in trading because traders take risk and they operate in the uncertain environment. Because we're just not designed to operate in the probabilistic environment by our nature. Because for the last 10 or 20,000 years we've been doing completely different things. But not operating in the probabilistic environment. That's why our brain exists in the cognitive dissonance mode. Because you are constantly observing, the price going back and forth, so that provokes emotions. And if you have a position in the market, if you take risks, so the emotions become more vivid in this case. And there is a simple fact, which we know from the prospect theory, that when you have a loss, so your emotional reaction is maybe 1.5 or even more intense than in comparison when you have a profit. That's easily explainable because from the evolutionary point of view, you need to survive, right? So you don't need. So you might live another day without the food, let's say, or without the profit, but you need to survive. That's why emotional reaction is very much intense when you experience the loss. It's less intense when you experience the profit. That creates this asymmetry in the markets, which leads traders to take their profits fast and to lean on their losses, actually. And that's why many traders struggle to maintain discipline. They struggle to hold their positions. That's why too often psychology is being blamed for bad trading decisions. So that's rooted in our deep type of reaction.
Yeah, it's easier to hold on to a loss and hope it reverses, and rather than holding on to a profit and keeping open.
Exactly. So when you fix the loss, you fix also not just the loss, but the painful emotional state, because nobody wants that, and you would rather let your position float, or maybe reopen it immediately. To have a hope of gaining it back.
So do you think people underestimate how much psychology affects their execution, even though the strategy might be like you have the perfect strategy? When psychology kicks in, everything is messed.
I would say that depends on the person, depends on the phase of a trader development. So psychology kicks in pretty much intensively in our execution. So first of all, if you don't have a strategy, if you don't have an edge, well, that's one thing. So I think you should think about getting it. But if you do have an edge, if you know that you can earn money from time to time, so you can create winning streaks, there are, I would say, several popular themes in emotional management, let's say. First of all, people tend to leave their losing positions, to go against the market, fight the trends, because they failed to fix the losing position. That's one thing. Another thing is overtrading, when they got involved into the constant action, getting in and out. So that's another thing. And sometimes they trade with big leverage, with small stops. That's also emotional type of thing. So that does not justified. It cannot be justified from the probabilistic standpoint. So of course, these actions might sound like or might feel like natural, coming naturally. So, okay, I need to get in the market because I feel it will go up. But in fact, that's our emotions. They provoke us to do things that spoil our expectancy or expected value of our trades. Experienced traders, they pretty much know it. They can spot it when such behavior is happening.
Yeah.
But sometimes in the heat of the battle, you might forget about that. You might still make some mistakes because basically if you lose control, if you let it go, if you let go of your trading plan, if you lose control a little bit, so you might gravitate towards your natural type of behavior, which doesn't have to do anything to earning with the markets.
Yeah, usually you try to revenge trading, try to get back what you lost, and psychology kicks in then.
The intensity is so high that, of course, you want to get back. Because it's too difficult to see how someone deprives you out of the resource and you can not do anything about that. So just immediately your body or your subconscious mind turns on protective mechanism.
Speaking about trader psychology, I would suggest you to click the link in our description to read the full article about this episode of the podcast and also sign up for the Exness newsletter to receive weekly updates about the markets. Okay, so when we're talking about trader psychology, it's usually imbalance between fear and greed, right? So how do you have any examples that fear actually saved you from a bad trade? Like because you were fearful, you eventually saved yourself from a bad trade.
Well, for example, when oil was going down in 2020, so to almost to zero.
Yeah.
The greed was telling, so man, it's like $1, so you gotta buy it, right? You buy the future or ETF related to oil, but the fear was telling me, well, there's something weird here, so that's
does not make sense.
It doesn't make any sense. So you gotta back off. You gotta not do anything in this case. Later on, we've seen that oil got to minus 35.
Yes, it went negative.
37, and many people lost money because of that. So yeah, greed was whispering, get in, and the fear actually prevented me from doing so. I didn't lose money back then, and that was a good thing.
Okay. Do you have any specific habits, let's say, or systems that help you keep that fear in check?
Well, I would not say that I experience, paralyzing fear or anything like that, but I would say that's a respect to the market, respect to risk. A little bit of fear is useful, because you need to understand that if you overtrade, if you're, too active in the market, so that will not end well. I would not say that it's fear necessarily, but maybe it's understanding that you should not do anything without any justification. Or fear might be helpful when you navigate in the new markets, in the new strategies, in the unusual situation. When you don't have any experience, then the fear might help you back off a little bit because the situation looks unusual, so you don't know how to handle it. Fear might be your ally in this case.
Okay. And on the contrary, we have fear, but we also have greed, right? So what do you tell someone who just can't stop chasing the next big win? Like greediness kicks in and they are trying to get more out of the market.
So I would distinguish here greed from risk appetite.
Yes.
Risk appetite might not be the bad thing unless you understand that what you're doing. Greed is a state of mind when you actually don't know what is happening actually. So you place inadequate targets, you expect unreasonable behavior from the market, not backed by probabilities, maybe not met in the history. For example, you want the market to skyrocket to a certain level, no justification. So that's greed.
Everybody wants that, right?
It's not rooted in reality, I would say, that the state which is not rooted in reality. Risk appetite, on the other hand, might be when you're existing in reality. So you rely on some models, statistical models, technical analysis, whatever it is, but you are complied with reality. At the same time, you're a little bit of more aggressive. So that's not a bad thing, because I have a model when you have green zone, yellow, and a red zone. Red zone is associated with greed. Yellow zone, when you're active enough, but you still are, in contact with the reality, you have a tight grip with what's going on in the market. So you got to be in the yellow zone, not transition into the red zone. It's very difficult because sometimes you can go to the red.
It's a fine line to balance.
The line is very thin. Yes, you should not cross it. But risk appetite is actually good unless it goes to the greed state.
Okay, so when we're talking fear and greed index, my mind goes to cryptos, right? So why don't we check on some charts? Probably I don't know what you want, Bitcoin, Ethereum.
Yeah, let's watch Ether, because I think it was more volatile this year. So we see that ETH or Ether or ETH USD was actually the classical example of some FOMO behavior when it has broken in July 2025. So you see that this rally had almost driven it to the twice the price higher. So that's an example. Later on, you see those spikes, the big volume candlesticks in August, for example, August 21, but it was a subject for the latest sell-off. Sell-offs, spikes to the upside, so that's a representation that the sentiment is gone actually, but the traders continue to do the same thing. So they want to see it skyrocketing higher, but basically these are very short-term moves. So that's a classical example of the overheated market that turns into sideways consolidation, very choppy, very frustrating for many traders. And now it is in this state of frustration as we record this video.
All right. So thank you very much, Stan, for providing your viewpoints.
Yeah, thank you for having me.
Thank you for watching this until the end. In our next episode, we will discuss liquidity and sentiment, how to manage risks in low liquidity periods, and more. If you enjoyed this episode, don't forget to give us a like and subscribe to our channel for the upcoming episodes of our podcast.